Hello traders, the title of the video is swing trading versus position trading, the whole truth. I've been asked by a TSTW S008 trader. He wants to know, is it better to swing trade? Is swing trading better than position trading? All right, that's why we are recording this video today. Let's get started. The first thing that I need to understand is that we have many market participants in the financial market. So we can say that the long-term investors are the long-term market participants are the investors, okay? Those who buy and hold for up to 10 years, 5 years, long-term investors. And then after that, we have what we call the position traders, all right? Technical traders, and then we position traders, which are mostly hedge funds or hedge funds, and we have also the swing traders. All right. So, and then we have day traders. So, what is happening in the financial market is that when there is an opportunity for the investors, okay, all right, a large pie, so to speak, for the investors, you can bet that the hedge fund will take position because they know that the investor will be busy loading it. So a few years ago, it makes sense to buy gold and hold for, okay, almost 10 years now. And if the position trader notice that the investor are likely to buy gold, then they will take position. That's it, they will take position because there is opportunity for the investors. Now, on the other hand, this is what I say to you. If you are a swing trader, that's why it's so important for a swing trader to understand how the position traders make their decision. The same thing, a position trader understands very well the investors. So we are all eating the plate of another person. So day trader who understands swing trader will be better day traders because they will use the signal of the swing traders as their day trading setup. And a swing trader will use a position trader signal as a swing trading setup. The same thing, the position traders will use the investors or signal to buy or sell as their trading setup. All right. Now, those are the things we need to understand. So, the next thing that I want you to understand, when we are talking about a swing trading, we are talking about, generally speaking, swing traders are technical traders. So I will say that 70% of swing traders are technical traders. They understand Fibonacci, Pitchfork tools, stochastic, and so on. They are technical traders. But if you want to be a position trader, you want to combine technical analysis and fundamental analysis. Never call yourself position trader if you are the purest technical trader, because at least either way you have to understand the market cycle, and you can't take position because a position trader will hold position for a year at least, all right, or a quarter, at least minimum a quarter up to a year. So a position trader can hold a position minimum 1 year to 4 years. So how can you stay in the market? So the longer you stay in the market, the higher the risk. You don't know what's going to happen day after day. So it is impossible to contemplate position trading without thinking of the fundamental, the implication of the fundamental and the market cycle and the global economy. All right? So swing traders are technical traders, 70% of them. But one will be a better swing trader if one understands the hedge fund. So if you want to understand the hedge fund, which means the position traders, the hedge funds are position traders and they move the market. So if a swing trader wants to be a better swing trader, he or she must understand the position traders. So talking about understanding the position traders, you want to understand them technically speaking and also fundamentally speaking. So you will be doing what we call Google Asset test. You will be checking the fundamental, the story, the balance sheet, the cash flow, all those things. So you become a better swing trader because you're going to eat, so to speak, in the plate of the position traders. which is very, very important. Now, the next thing, position traders are those who understand the market very well. In fact, they use technical analysis, EDR way, Fibonacci. Not only that, they understand also fundamental analysis. So if you want to be a position trader, you become a very serious swing trader. You move to the highest level, meaning that you're going to do your due diligence both ways. Either you outsource it, somebody doing it for you, and then you apply your technical analysis. So you may see a technical trading setup, which the position trader will do. They will use Fibonacci retracement. They will use the divergences. But before they will buy and hold, there must be fundamental reasons for it. So one thing I want to clarify with you when we are talking about position traders, the position trader pay attention to the S&P 500. Very, very important. So some position traders do not understand all the things that I'm going to discuss with you here, and some of them have lost money and they have to close down. Some hedge funds, they have closed down because of that. So if this is the S&P 500, so they are making decision talking about fundamentals, but they know about the EDR wave, they know about the market cycle also. So you can see that the S&P 500, as we are looking at it, as things stand today, I'll go to the, you see, monthly chart, okay. We are now in the fourth wave, expecting a fifth wave. So they know where we are talking about the market. So the smartest position traders do not just buy and hold like an ordinary investor, long-term investor, that say the market is going up, therefore I will buy and hold. They say the market will go up more. But the smartest position traders know the market cycle, and they will be buying, and they will start selling when the market is about to reach the fifth wave or a correction is due. Or they will become very, very defensive when they know that the market will turn around. So the time when those position traders will buy, they usually buy and hold. The best time is at the beginning of the third idiot wave. All right, market pullback become oversold. Those are the time when they come into the market. But they do not just look at the S&P 500 alone. They also pay attention to the central bank. The central bank play a lot of role in the life of a long-term investors and the position traders. Because you need, okay, an environment that will support your investment, your long-term investment, your medium-term investment. So, generally speaking, that's why the hedge fund will hold position maximum 4 years. They use the American presidential election cycle. So, one president coming, another administration is in place. What is the policy they're going to put in place? So, the previous government of Obama was devaluing the dollar. So, because of that, a specific, okay, a strategy will be put in place, which means, okay, the stock market has a high chance to go up, okay, cheap money is now available, all right, and people are speculating in the financial market. The dollar is going down, all right. People will buy gold to protect themselves against the inflation. So this is what one thing I was explaining to you before, is that in order to achieve, I will talk about in another video, talking about how to achieve consistent winning trade, whether as a day trader, swing trader, or position trader. That's another question that you have asked. So this is it, talking about swing trading and position trading. You will be a better swing trader if you understand the position traders, which means you start combining your technical analysis with the fundamental. Very, very important. Another thing I want to mention here, talking about swing trading versus position trading, the position traders love the quarterly chart. They usually look for the trading setup on a quarterly chart. And then they will break it down, quarterly chart, okay, weekly chart, okay, and 4-hour time frame. So their signal is on a weekly chart. But I do not recommend to traders to use the weekly chart very much. Why? Because, in fact, the best hedge fund do not use the weekly chart. They use a 3-day chart. So I'm using the TC2000 here. They use the 3-day chart. This is a 3, 1, 2, 3, 3-day chart. for their signal instead of the weekly chart. Now, I see all the time traders use the weekly chart. If it's working for you, that's fine. I would rather use the monthly chart than the weekly chart. That's my personal view. Please don't ask me why. Because of what I've seen on the weekly chart, I prefer to use the quarterly chart. I prefer to use the monthly chart. All right. So if you understand that the position traders are using the quarterly chart for their setup, the weekly chart for their signal, and the 4-hour time frame for the entry. Some of the position traders will use the quarterly chart for their setup, but they will use instead 3-day chart instead of weekly chart for their signal, and will enter the trade either on the 4-hour time frame or 2-hour time frame. This is technically speaking, but they are paying attention to the S&P 500, and they are listening to the policy that the Federal Reserve has put in place. So the way the S&P 500 is looking to them, personally speaking, if somebody is buying and hold, that person needs to be very careful right now, because the market has been going up for some time. We see the first wave, the second wave, the third wave. We are not talking about the fourth wave. This is not the best time to buy and hold, personally speaking. The market can be extended, but I think at this junction, it's more about a technical play, carefully defensive. All right, because a correction can start at any point. The market can continue to go up more. But at this junction, it's better to proceed cautiously until we see another pullback or another move up. Okay. All right. So I don't want the video to be too long. The question you have asked is a very important question: swing trading versus position trading. All right. So the swing trading now, because you are TSTW SYS usual trader, we use the daily chart for our setup. The reason why we are using the daily chart in this case, you will say, Joe, you say monthly chart, but we are using daily chart. Why? Because of the technical indicators that we are using on the daily chart. But a TSTW as usual, a trader can look for a trading setup on a monthly chart with the same thing that we have said. Can use the monthly chart, even the yearly chart, look for a trading setup on the yearly chart. And then if you see a trading setup on a monthly chart or quarterly chart or even a yearly chart, he or she can go to the signal time frame and wait for the signal. That's it. The trading setup will generate the signal. All right. Okay. But now, normally, when we are talking about different time frame trading method for swing trading, we are talking about, monthly chart, for the setup. Your signal will be on the daily chart, and your entry will be on the hourly time frame. If you don't want to enter the hourly time frame, when the entry is in place on the hourly time frame, you wait again and go to the 10-minute time frame to enter the trade. Now that's why TSTWSY is usually a trader enter the trade on the 10-minute time frame, because our trading setup is on the daily chart, and signal hourly time frame, entry 10-minute time frame. Now, you can go directly from the monthly chart to the signal time frame for the TSTWSY08 and then enter the trade on the 10-minute time frame. You can do that. All right. So this is about swing trading, technically speaking. All right. Now, if you are swing trading, you need to pay attention to the economy. Most swing traders, as I told you, they are 70% technical traders. They don't want to know about economy news. They don't want to know where is the S&P 500. And they usually enter the trade on Monday, and then by Tuesday they lose. I say to traders, be patient, see Monday to come out, and handle it nicely on Tuesday. Possibly best scenario, you see best setup on Tuesday, but that's not a rule. All right, it's just something you need to be aware of. Again, if you're leaving a trade open through the weekend, know that sometimes news can affect your swing trading. So you need to secure your position. All right. Through the weekend, because anything can happen. Monday, price gap down or gap up, and you lose. You don't want to lose. Very, very important. All right, this is something. Friday. Now, Friday is a funny day for trading. All right, because the market is about to close, and a lot of market participants will leave the market. You want to pay attention to a quarterly candlestick bar is about to close, because position traders do pay attention to the quarterly candlestick bar that is about to close. Okay, end of March, end of June, end of September, end of December, beginning of a new year, and so on, all right? And this is it, okay? But a position trader will hold position up to 1 year or more. They pay attention to the American 4-year election. They are taking advantage of the long-term investors, but they are not only fundamental traders. They are what we call the sophisticated market participants that are combining. They know everything about the market, technically and fundamentally. That's why they can pull a lot of money out of the market, because they are playing in both ways. While the traditional investors use fundamental analysis alone, but they get into trouble when it comes to market timing. And sometimes they lose, they may make money, and then at the end they lose at the top of the market when they are still buying instead of coming out of the market, all right? So if you want to be a position trader, one thing I will say to you, you need a lot of money if you want to be a position trader. That's for sure, because you're going to use a bigger stop loss and you're going to remain in the market for a longer period. You need a lot of money. Now, the question is, can you afford that money? Okay. What I say to traders, you never use more than 5% of your wealth in the financial market. Just take it from me. Never use 5% of your wealth in the financial market. It's just because of the risk. The 5% money management rule is applying to your trading account, to your wealth, to everything that you are doing. So if anything happens, all right, I lost so much money in the financial market, and I say to traders, the traders say, Joe, you're too defensive. Well, I'm defensive for a reason, okay? This is it. So, all right, so few things I need to mention. So you swing trading, monthly chart, daily chart, hourly time frame. If you don't want to enter on the hourly time frame, you go to the 10-minute time frame. Position trader, quarterly chart, weekly chart for the signal, or 3-day chart for the signal, entry on the 4 hours or 2-hour time frame. If they don't want to enter on the 4-hour time frame, they will go to the 15-minute time frame. But the entry, when you see it on the 4-hour time frame, that's when you will now switch to the 15-minute time frame. You're not going to bypass the 4-hour time frame and go directly to 15-minute time frame. The same thing when you are seeing your trading setup on the monthly chart for the TST WSY008, you don't bypass the signal time frame. The signal time frame is a very important time frame for every top-down trading method. All right. Personally, I don't like the weekly chart. All right. Please don't ask me why. Okay. Now, when we are talking about the quarterly chart, we are talking about the yearly chart. Okay. Same thing. You have to, when the position traders see the setup on the quarterly chart, they always investigate on the yearly chart. But before that, they will do the fundamental analysis. Talking about the sector, you asked me also a question: which sector should you invest in? I'll be recording a video also about that. Okay, I thank you for your patience, because I promised you to record a video before. One thing: the hedge fund are position traders, the long-term investors and the position traders always pay attention to the central bank. The central bank, the current administration, the decision that they are making will determine the global economy, environment. So from there, they will decide whether they should invest in the stock market or in the bond market or buy gold or so on and so on. This is it. Which sector will benefit? Money coming out of which sector? Which sector is likely to lose? All right? And also they pay attention which sector is oversold, and they pay attention to the market environment, the policy that the central bank are putting in place, all right? And then with that, they will play on that field. So the central bank are like the referee, all right? So if you want to be a position trader, first you need a lot of money. Don't go around calling yourself position trader with $20,000 account. I mean, you may get away with it if you are lucky, but I think you need a deeper pocket. That's why they use client money. Now, if you are a swing trader, what I would recommend to a swing trader, try to learn more about position trading and also from the investors. That can only be useful to you as a swing trader. So I leave it to you, all right? And let me know which one you prefer. At the end of the day, a swing trader is eating the plate of the position trader. Position traders are eating the plate of the long-term investors, you see. And the day traders are it in the place of the swing traders. All right. As a swing trader, sometimes you may enter a trade today, all right, and the market may print something like this. I need to mention that before we wrap it up. It's about taking profit, all right? I will be talking about that also. So the market some days will go up big time, all right? So you have a long tendency back. So suppose you are here, you sell it here, okay? And then that day the price went up big time. Just secure your gain or take the profit. Take the profit. Sometimes swing traders hang around so much and they give back the profit. Take your profit, celebrate, put it in the bank. If you do not bank it, it's not there. This one thing I said, keep banking the profit. Consistent winning trade, meaning banking the profit consistently. So when you have a losing trade, there is money somewhere that you're already bound that will compensate for it. But if you didn't take that profit and then you have other losing trade, there's no compensation left. So you need to build a form. This is your defense. All right. Banking money is very important in the financial market, especially if you're a swing trader. All right. So you are looking for the best setup. Someday, so you enter the trade, you're thinking to stay there for a week. So that particular day is here, woo, nice. Take it. Just take it or secure it. Or move your stop loss to secure it at least. And sometimes you will be glad that you take the profit or you will be glad that you secure it. The market sometimes will change direction. And people will say, so suppose you were here, so you are swing trading here, okay, so you sell, you went down, you say, oh, this thing is going to go down more. Yes, it's going to go down more. You see, it went down more. You were correct. But look what it did before that. It went up. You have enough stop loss to handle it. And this is it. Keep taking profit when you can. And I'm not saying that leave money on the table. I just know that taking profit is very important, all right? And as I said again, 5% of your wealth, that's what you play with in the market, and nothing more, nothing less. That's it, full stop. With that, there are better things men can do in life. So I will never recommend to somebody to go and waste money, okay, and go home empty-handed. So this will conclude our discussion today about the swing trading versus position trading. So in conclusion, swing trading is in comparison to position trading, is a short-term trading that can take up to 1 to 3 days. All right, some swing trader may stay for a week, which is beautiful sometimes, but generally we are talking about 1 day to 3 days. So people enter on Tuesday, but Thursday they come out. Sometimes you may remain 2 weeks in a swing trade, all right, 2 weeks. So you are managing that. You're going to manage your trade carefully. Now, the position trading is a medium-term, okay, market participation in comparison to long-term, okay, investors. So you are talking about a year, and sometimes a year, so they will take profit at the end of the year or at the end of a quarter, something like that, and then definitely they are paying attention to the 4-year, okay, presidential election in the United States. But generally, when they are saying 4 years, doesn't mean that they stay in the trade for 4 years. They are coming in, they are coming out, but they with the fundamental analysis, they say, all right, this sector is likely to go up more as long as the policy stay the same, central bank. So they are coming in, they are coming out, they are coming in, they are coming out, okay, and they will get out. But there are investors that hold position for longer period, 5 years, 10 years. They will say gold can go out for 10 or 5 years. So they keep buying at different level. Doesn't mean that they don't cash out, they don't take some profit, they will be taking some profit, but they're in position for long term. But when they are doing that, they use a hedging. So they will buy, okay, another financial instrument that may go down if the other one is going up. So they cannot take one directional, okay, a unidirectional position. So it will be crazy for a long-term investor to buy, okay, and just say, definitely it's just going to go up. I've done my fundamental analysis. It's going to go up. As they take position for long term, all right, so they know that if the stock market is going to go up, okay, for a long time, all right, gold may be going down or something else may be going down in the financial market. Therefore, they have to take that position also, betting that the other financial instrument will be going down when this one is going up. So if this position has failed, the other one will compensate to it, okay, as they are, okay, negatively correlated, all right? So financial instruments that are negatively correlated, they may buy them together, all right? So you know that, okay, you buy this, okay, it's going to go up, and when this one is going up, okay, this one will go down. All right. So what you will do here, you buy both together. So this one is going up. You don't want to sell this one. Also think so. That's one direction. So if you buy this one, you know that when this one is going up, this one will be going down. So if you buy this and you sell this, it's one direction trade because this one going up, this one is going down. That's not good. All right. That's not good. So to protect their position, they will buy this one also. So when this one, because they have a big position here, so when this one starts falling, what will happen to this one? This one will go up a bit. It's about hedging. That's a different matter, complete different topic that we can discuss in another tutorial. So all in all, I touch upon, okay, swing trading versus position trading. Have any question or suggestion, please put in the comment section. And in due course, I will be recording another video to answer your specific question. Thank you for watching, and I will speak to you soon. As I said to you before, I will answer all your questions. All right?